Hi, and welcome to the Down to Finance podcast by Future Finance Group. We recently hosted our first-time investor seminar, bringing together experts from lending, accounting, property, planning, and more. Across the night, there were plenty of sharp insights and real-world guidance, so we're distilling some of the best moments for you here. In this episode, you'll hear from Jewell of Index Wealth. Ricky spoke about long-term financial strategy, choosing the right structures, managing risk, and how property fits into a broader wealth plan. Without any further ado, here's Ricky.
The joys of going last. Some people have already talked about what I was going to talk about. I mean, you took about half my presentation, but I'll try and switch it up as we go through. But yeah, no, thanks so much for having me here. I've been working with Future Finance and Amy and the team for the last 7 years and really appreciate the relationship. And thanks so much for having me here, and what a beautiful venue as well. So Amy, starting off with a disclaimer, this is all general advice. Really great that Amy said at the start, just because your friend or your neighbour did something doesn't mean you should as well. Always make sure that, you speak to the experts and, they really understand your situation and the advice is tailored to you and your goals for the future as well. Thank you. Who we are, so we're a team of 9 licensed financial planners. We've got about 70 support staff, so there's 80 of us now. We manage around about 400 million for our clients, and we've been in business for the last 13 years. And our mission is basically to make financial advice accessible. There's sort of this idea that seeing financial advisors, you have to front up 10, 15 grand to see someone. So, we try to sort of make that information accessible, especially because there isn't a lot of education out there. So that's our mission as well. Alrighty, so yeah, our services sort of range in many different areas. We sort of really try to understand our client's circumstances and, tailor the recommendation to what's suitable for them. But if you were to break it down into 4 pillars, we help clients with personal insurances. So, life insurance, income protection, all the fun stuff, pretty much making sure that someone's protected in the background. Superannuation, as Adam was mentioning before, such a great structure to be able to build wealth and minimize your tax, and that's pretty much half the game of investing, is how do you pay less tax as possible. Investments in general, so we delve into a lot of managed portfolios and managed funds and the like. I guess today's conversation is really around property, but of course it is important just to consider all types of investments in the background, just to make sure that you do have a diverse portfolio. But property, of course, is such a fantastic investment to build wealth. And then ultimate retirement planning. There's different structures, for example, pension structures when someone retires, with superannuation in particular, where, as Adam was saying, you pay 0 tax on the income that's generated from those investments. So a lot of conversations around how much investments do I need to be able to retire? What income do I need? What age is that? So a lot of conversations about the retirement planning piece in the background. If you could just double tap it twice, thank you. So going back to structures, again, what Adam was talking about, when it comes to tax and the impact of tax, this is just an example to show that when there's compounding 20 times in a situation where someone's paying no tax compared to 25% tax every time it does double, there is a huge difference to what that money looks like down the track. So it's so important just to make sure that ultimately we're taking into consideration not just the investment itself, but also the tax implications in the background. Next slide, please. So the different tax rates and the different structures. So of course you've got your personal, company, superannuation. Again, thank you, Adam, for breaking all down all the structures in the background. However, of course, it's so important that each of those structures have pros and cons, and again, it comes back to your goals. So when it comes to anything investments or what you're planning to do, try to have a really clear goal of what you're trying to achieve, what age it is that you want to be in a position of, let's say, financial freedom, and what sort of income that you're looking to sort of derive from those investments. And then from there, you can sort of pick the structure that best suits that strategy as well. So superannuation. So this is probably one of the areas that we do focus a lot, mainly because of the tax efficiencies of it. Of course, there are some restrictions in terms of when you can access the money in the background. So there's a lot of pros and cons, but it's such an important area where I feel like there's not a lot of education and a lot of people don't really consider it as much. A lot of people have superannuation and they're putting 12% of their income every year into this space. But, a simple question, when has your superannuation company ever called you to go through your investments and fees? And I always get the same answer, never, right? So it's so important just to sort of look at, okay, if they haven't contacted me, they don't know my situation, but they're investing it in the background, how are they investing it? Is it actually in my best interest, or is it more set up on a more convenience basis for them in the background? So like I was saying, 12% of your income is going to an area, let's say 40 years of work. It's a long time of a lot of money sort of accumulating. It's so important, again, to make sure that, it's being invested into the right asset, but it's also the right asset for you. Generally speaking, if someone's younger, they can be a little bit more aggressive on the investments. And if someone's getting closer to retirement or in retirement, then they might want to be a little bit more defensive, more income generating at that stage. So three major benefits when it comes to superannuation. Firstly, contributions going into super are usually tax deductible. We can claim that tax deduction and reduce it off your personal income tax. The growth of the asset over the years is tax less. And then ultimately when you get into retirement, tax free essentially as well. So again, a lot of things that go into the background of that, but that's usually sort of the overall summary of the benefits. So lots of different types of superannuation structures. Main three are retail, industry, and self-managed super funds in the background. So again, each have their own pros and cons. It's so important to get the right advice when it comes to the different structures. Probably the two words that people always miss with the SMSF is self-managed, right? So really important that, if you're doing that type of structure, is that you've got a lot of advice around it, because what we find is all the horror stories happen there, but there's also a lot of success stories as well. So having the right information and the right advice going down that pathway is very important, because it's quite actually easy to set up a self-managed super fund, but when you're trying to wind it down, that's when it gets a little bit complicated. And ultimately you want to be making sure that if that's your retirement fund, you're making the right investment decisions in that space as well. But again, lots of different structures in the background that's available, and it's trying to, again, tailor it back to what your goals are, what you're trying to achieve for the future. So the next thing just to talk about is the insurances. So this is probably one of the areas that sort of gets neglected a bit. I feel like it always becomes a much more important of a conversation once something's happened in the background to someone's life where they need to claim. And so it's a conversation that's very important, and I guess trying to relay it back to someone's situation, but then also making sure that it's reviewed on a consistent basis as well. So these insurances are very important. Life, TPD, trauma, and income protection. Just to briefly go through each one, life cover, pretty self-explanatory, that one there. If someone is no longer around, that money gets paid to their family. TPD, total permanent disability, that's if someone can't go back to work ever again. It's a lump sum. Income protection, someone's been off work more partially. It's an income that replaces their salary until they can return back to work. And the last one's trauma cover, which is usually the one people don't hear about too much. That's the one that if someone's been diagnosed with like a heart attack, cancer, or stroke, it's a lump sum that gets paid to them, and they use it for maybe medical costs in the background as well. Who needs insurance? So I guess it's the idea behind these types of covers is trying to identify what is necessary for someone's circumstances. The question that I always ask clients is, can you retire tomorrow? If the answer is no, there's probably some sort of coverage that's necessary, but it's trying to quantify what's necessary for that person, and then ensuring that it's going with the right company to facilitate that structure as well. But usually the key sort of reasons behind this coverage is if someone's relying on their income to cover their expenses, if someone has children, dependents, and if they've got a mortgage or some sort of debt in the background as well. So those are probably the major key situations, but I guess everyone's circumstances are very different. So it's a really important conversation to talk about, okay, based on your situation, what sort of levels of cover would be necessary for your situation as well. Beautiful. That was pretty much everything from me. So yeah, I guess as a summary, going back to the structures, as Adam was saying, so important. I feel like a lot of people talk about the investment, but they don't talk about the structure of where that investment sits. So that conversation is so important at the start, because once it's set up in that structure, It's very hard to then change it without tax implications. And how you get that right is really figuring out what is your overall goal and what's your financial plan. So I think trying to really figure out what's the purpose in the first place is very, very important, and then making sure it's the right structure, and then pretty much making sure that someone's got the right covers in place, just in case anything does happen, that person can, cover not just themselves but their family, but of course just ensuring that it is right for your circumstances. Awesome.
Thanks for joining us on the Down to Finance podcast. If you enjoyed this episode, follow along on socials and hit subscribe so you're always up to date. Just remember, nothing you hear here is personal advice. Everyone's circumstances are different, so have a chat with your broker or financial advisor before making any moves. And if you're unsure where to start, Future Finance Group is here to help you map out the right path. Catch you on the next episode. Thanks so much for listening.